Well, in less than an hour, we're going to get the monthly jobs report for November, one of the last major pieces of economic data this year that could determine what the Fed does with rates in just a couple of weeks. And joining us right now to talk about it is Ian Shepherdson. He's the new chairman and editor-in-chief of Pantheon Macroeconomics. Congratulations on the new title, and it's great to see you.
Yeah, thank you. Thanks for having me.
All right, this number, what are you anticipating? What are you thinking?
Got to be a big rebound. October hit by the hurricane and by the Boeing strike. So the real question is whether the rebound puts us back onto the previous trend or whether it maybe falls short a bit, because the signals are mixed. There's some evidence that hiring may be stabilizing, but there's some other evidence that says it's still deteriorating a bit. So I'm interested in both the November rebound, but I also want to see the revised October numbers, because the October print was based on a very small response rate. A lot of people didn't reply on time. So we could get a big revision to October, potential revision to September as well, and November. So
what if there's not a revision? Just Steve Leisman was talking earlier about how holiday hiring has been smaller this year, maybe because it's a shorter holiday season. What if that impacts things and we don't see a big revision?
Yeah. So if the October number stays around zero, the initial estimate was 12K. So let's say it stays around zero. And if you think the trend's about 125, you need a 250 for November to keep you on the trend. So that's a little bit above the consensus, which is kind of around 220. But I think 250 is a reasonable starting point. So if October remains close to zero and we come in at like a 175 for November, you're going to get a lot of people talking about, hey, the trend is continuing to deteriorate. And that will really solidify expectations for the Fed to ease later this month and maybe start pushing some expectations for next year as well.
We had a guest earlier this morning who talked about how inflation, where he sees it, is really on the upswing again. And I just wonder how the Fed does this. Do they have to be one of those fish that have eyes on either side of their heads? One eye watching the jobs market, the other eye watching inflation, and which eye is the dominant one?
Yeah, they always have to do that. Over the last 6 months or so, the underlying inflation picture has improved. But yeah, the last couple of prints haven't been great. But we saw this earlier in the year. The prints at the start of this year were disappointing, and the Fed, I think, overreacted to those numbers because the next few months then swung the other way. It's really important not to take these very short runs of data for anything very seriously, because everything gets revised. Everything is subject to sampling error, seasonal adjustment problems, weird weather effects. It's very dangerous, I think, to focus too much on just the latest number, because it could easily just flip the other way the following month. I think the fundamentals for inflation, to me, still look good. Wage growth is slowing. I think it's already at a target consistent pace for inflation. We don't have the supply chain chaos that we had a couple of years ago. We got a much calmer rental market, big chunk of the CPI. And so just the overall environment to me looks quite favourable. But any given month, anything can happen, and the Fed has to be aware of the risks.
All the Fed commentary from J. Powell down seems to be kind of signaling that they're not going to be in a real rush to do anything, that they want to wait and look around. Why isn't that an argument for doing nothing at this meeting and waiting to see what happens?
Yeah, I mean, I think that's a respectable argument. I'm not sure that it's absolutely essential that they do 25 basis points in 2 weeks' time or the sky will fall in. It won't. However, they've allowed market expectations to ramp up that they will. So if they don't, it'll be a really big surprise now. They're not really in the big surprise business, so they're going to go.
But we're a bunch of crybaby whiners. We please the market. This is what we think is happening. We're throwing a temper tantrum.
To some extent. I mean, they don't like they like to manipulate expectations in the run-up to the meeting. They don't like to deliver a big surprise at the meeting statement itself. So what I think they're also going to do, because December's a forecast month, so they've got to put out new projections. I think they'll probably raise the inflation projections a bit, and they might move the unemployment numbers up a little bit as well, but not very much. But I do think that in the press conference afterwards, and then the array of speakers in the week or so after the meeting, they'll be dampening expectations that they're going to keep going at a rapid pace. They're going to keep talking about caution. And my guess is they'll skip January, wait and see what the incoming administration does in its first few weeks, and then revisit the issue in March when they've got a clearer idea of where we're going on the fiscal front, on the tariff front, on the deportation story, which a lot of people are worrying about, shrinking the labour force. A lot of uncertainty, and it's not clear to me that, it makes a huge amount of difference whether they go another 25 in January or whether they take a pause. Got to be realistic here. Whatever they do in the next couple of months doesn't affect the economy for a year and a half anyway. It's not like we're in a sort of pressing crisis, so, yeah, wait.